Assalamu alaikum wa rahmatullah. In the name of Allah, the most gracious, the most merciful, praise be to Allah, and peace be upon His Prophet Muhammad, his family, friends, and the followers until the day of judgment. Our lesson today is a new chapter. This is financial statement analysis, and this is the last one in our course, financial statement analysis. And as I told you in the classes, this chapter is very, very easy, and its question is very easy as well. It doesn't need any effort from you. I will prove that when I explain this one, and you will find this true when you solve problems and exercises. First of all, financial statement analysis is very important, and there are two fundamental considerations in financial statement analysis. The first consideration is basis of comparison, and the other one, factors affecting quality of earnings. The first consideration in financial statement analysis is basis of comparison. Basis of comparison. The basis of comparison are: number one, the basis of an intra-company. The other one is industry average basis. The third one, intercompany basis. We'll start with the first basis of comparison, intercompany basis. This basis compares an item or financial relationship with a company in the current year with the same item or relationship in one or more prior years. Again, intercompany, it means comparison of an item or financial relationship within a company in the current year with the same item or relationship in one or more prior years. This is the first base. The second base is industry averages. This basis compares an item or financial relationship of a company with industry average or norms. Again, industry averages. This basis compares an item or financial relationship of a company with industry averages or norms. Norms, N-O-R-M-S, norms. It means the ideal, the one who should be norms. The third basis is intercompany. This basis compares an item or financial relationship of one company with the same item or relationship in one or more competing companies. Again, intercompany means compares an item or financial relationship of one company with the same item or relationship in one or more competing companies. So this is the three bases. Again, intercompany, number one, industry averages, number 2, and the third one, intercompany. The second consideration, as I stated, factors affecting quality of earnings. There are 3 factors affect quality of earnings. The first one, alternative accounting methods. You know, we have many methods or many accounting methods. We could use one and the other companies use another one. Violations among companies in the application of generally accepted accounting principles, GAAP, may hamper comparability and reduce quality of earnings. Again, alternative accounting method, it means violations among companies in the application of GAAP or generally accepted accounting principles may hamper comparability and reduce quality of earnings. The second effect is pro forma income. Pro forma income. This income figure usually excludes items that the company thinks are unusual or non-recurring. This is pro forma income. The third one is improper recognition, unsuitable recognition, incorrect recognition. Because some managers have felt pressure from investors to continually increase earnings, they have manipulated the earnings numbers to meet these expectations. So the third one is very important. So the other two, improper recognition, because some managers have felt pressure from investors to continually increase earnings. They have manipulated the earnings numbers to meet these expectations. This is the 3 factors affecting quality of earnings. Actually, it is important to compare different financial statement elements to other items. The amount of financial statement element, such as cash, does not have much meaning unless it is compared to something else. Comparisons can be done on an intra-company basis. As I stated, this base compares an item or financial relationship within a company for the current year to one or more previous years. Inter-company comparisons are useful in detecting changes in financial relationships and significant trends. Comparisons also can be done with industry average, as I stated before. This basis compares an item or financial relationship with industry average or norms. Comparisons with industry average provide information as to companies' relative performance within the industry. Finally, comparisons can be done on an intercompany basis. This basis compares an item or financial relationship with the same item or relationship in one or more competing companies. Intercompany comparisons are useful in determining a company's competitive positions. Then we have to move to the tools of analysis. Tools of analysis. There are 3 tools of financial statement analysis. The 3 tools of financial statement analysis are horizontal analysis, vertical analysis, and ratio analysis. Again, horizontal analysis, vertical analysis, and ratio analysis. The first tool of financial statement analysis is horizontal analysis. Horizontal analysis, the first tool, we will deal with it in detail now. This one evaluate a series of financial statement data over a period of time. The horizontal analysis number 1, the first tool, evaluates a series of financial statements data over a period of time. Vertical analysis evaluates financial statement data by expressing each item in a financial statement as a percent of a base amount. Again, vertical analysis evaluates financial statement data by expressing each item in a financial statement as a percent of a base amount. The third tool, ratio analysis, expresses the relationship among selected items of financial statement data. Ratio analysis expresses the relationship among selected items of financial statement data. I think we'll study now the horizontal analysis and the vertical analysis, and leave the ratio analysis for another time, inshallah. Horizontal analysis. I stated that horizontal analysis evaluates a series of financial statement data over a period of time. This example states how to use horizontal analysis. We have sales in years 2011, 2010, and 2009. The sales in these 3 years, as stated, is for 2011 150, for 2010 125,000, and 2009 100,000. So to make the horizontal analysis, we should select a base year to comparison. So we'll select year 2009 as a base year, and this we consider this year 100%. So if we compute the increase or decrease in the sales from the base year to the other 2 years, for the year 2011, the increase would be 50%. We compare 150,000 to 100,000. The increase, the difference would be 50,000, which represent 50% increase. Also, if we increase the percentage, the base year is 100%, and the year 2011 is 150%, then the difference is 50%. Also, we compare the 2010 with 2009. The increase is 25% because the increase 25,000, which represent 25%. Or if we consider that the base year is 100%, then the year 2010 is 125%. Then the increase is 25%. We can compute the percentage increase or decrease from base year formula. This formula states current year amount minus base year amount over base year amount. In this example, percent increase in sales in year 2011 from year 2009 is 150,000 minus, it is a current year amount, minus 100,000, the base year amount, over base year amount. It will give me 50%. And this is the horizontal analysis. It is very easy and very important, as I said. This is the first one. Then we can move to the other type of analysis. We call it vertical analysis. Vertical analysis evaluates financial statement data by expressing each item in a financial statement as a percent of a base amount. Evaluates financial statement data by expressing each item in financial statement as a percent of a base amount. Look at this example. For the same company, we have 2011 and 2010. We have, this is the, as you see, this is income statement. We have sales minus sales returns. It gives us net sales, and the cost of goods sold, we deducted it from net sales. It gave me gross profit. Selling expenses and administrative expenses is deducted from gross profit as total operating expense, because selling expense and administrative expense, both we call them total operating expenses. We deduct total operating expense from gross profit. It gives me net income, or net income from operations. This is in amount, and we can transfer the amount to percent. We consider that net sale is the base, so we compare any figure to net sales. Net sales is 100%. Then the sales represent 105.73%, and sales returns is 5.73%, and cost of goods sold represent 75.27%. Then the gross profit in year 2011 is 42.73%. Selling expenses represent 15.86%, and administrative expense represent 8.81%. The total of operating expenses, I mean the selling expense and the administrative expense, equal 42.76%. The net income is 18.06%. This is for year 2011. We can do the same for 2010. We have the amount, and we can translate or transfer the amount into percent, and the base is net sales. Net sales is 100%. Then we can compare all the figures, sales and sales returns, and selling expenses and administrative expenses, and then we can get the net income for this year. So we can make the comparison for this company, the same company, between 2 years. As you see, we can compare the sales and net sales and cost of goods sold and net income. It is clear that this year it has a net income more than the other year, 2010. This year the net income is 18.06%, and in 2010 it is 16%. So I think it is very easy to do this vertical analysis. We can do it, as I said, in all the financial statements. We start with the income statement, and we can do it in the balance sheet and retained earnings statement. Also, we can use the vertical analysis to compare common size analysis, big company with a small company, because the numbers itself, we can't compare the number between for big company and small company, but by using the vertical analysis we can compare different size, big company with a small company. So we have the same example. This is big. If we assume that this is big company and this small company, we have the same numbers, then it gives me the results you see in the example. It is very easy to compare big companies with a small company if you want to make comparison, if they are competitors and if they are in the same industry. So this is vertical analysis. So both vertical and horizontal analysis can easily used, as you see. And inshallah in other lessons we can take some examples or some exercises to solve such a problem using the balance sheet and the retained earnings in comparison, because it is easy also to use this comparison in balance sheet and the rest and the other financial statement. Thank you very much, and I'll inshallah we'll see you inshallah in the rest of this one very soon inshallah. Assalamu alaikum wa rahmatullahi wa barakatuh.